The risk of a recession may be on the rise. Oxford Economics now says there's a 45% chance of a downturn in the next 6 months, thanks in part to the weak economic data so far this quarter. And it looks like a lot of companies agree. A new Gartner analysis of earnings reports finds a lot of companies are bracing for a recession. Gartner's Tim Raiswell led that research. He joins us now. Good morning. Tim, you say the words downturn and slowdown were 4 times more likely to appear in earnings calls from the fourth quarter. What does that tell you?
Well, it's first of all, thank you. Good morning, Alexa. Yeah, it's on the minds of executives and it's on the minds of investment analysts. It's the kind of the context around recession and slowdown was more kind of driven by market volatility and less around U.S. economic fundamentals. But China appears, Brexit appears next to those concerns as well.
But you know, Tim, Q4 was a pretty volatile time for the market. There was a lot of talk of recession. So should we really buy into this as an indicator of what's to come?
Well, you know, Gartner isn't a forecasting firm, and my job is to advise chief financial officers. I think the smarter organizations are the ones that are poised. They have their eyes on their order books, and you know, they're not too concerned with economic prognostication. They're watching their own results, earnings results, more closely. And so, you know, my job is to make sure that CFOs are primed. You know, the biggest challenge that executives face in any recessionary scenario is often convincing the rest of the organization that, you know, a downturn is imminent and that behavior needs to change.
You know, certainly we need to point out a lot of these business leaders are optimistic. We saw our share of positive earnings calls, especially in retail and tech. So, you know, who do we believe?
You know, so I think if you look at who is talking about downturn and slowdown and why, it becomes a little clearer, right? So it's the companies right now with more exposure to China, for example. So I was looking very closely at the consumer space. If you contrast that with the S&P technology sector, you find more buoyance and optimism there. So I think, you know, anything that makes financial planning more difficult, you know, the kind of the U word, uncertainty, it's around those topics that you will find the most concern from chief financial officers. And so in terms of who to believe, right now, you know, I would believe folks with exposure to China that the concerns are, you know, are real for them, and that the folks who are saying that, you know, 2019 strong in the U.S., you know, my kind of belief would be that those folks know better than I where the U.S. economy is headed.
So, Tim, if they aren't already preparing, is time running out for these companies to ready themselves for a possible downturn in the economy?
You know, I don't think so. The data shows previously that you know, cost cuts can happen quickly with inside organizations. I think the trick for the smart finance teams and the smart C-suites is convincing folks inside their own company that behavior needs to change. And so, you know, what's interesting for me is seeing that even though we are still in a economic expansion period, there are organizations kind of running through building the muscle memory when it comes to efficiency and cost management. That's a smart move right now, because what happens is you start to pivot internal behavior and internal beliefs about what value creation is for investors. And so I think that's where the smart executive time is right now, kind of preempting the official recession and focusing financial planning on what if 2019 was a recession year. You know, even if it isn't, you kind of come out stronger.